Welcome to today's explainer. Look, if you've been checking your investment portfolio recently and felt a sudden, alarming spike in your heart rate, trust me, you are absolutely not alone. Today, we're going to dive into a calming, structural analysis of all this recent U.S. stock market volatility. We are going to look right past the noisy, panic-driven headlines and use the actual data to uncover what is really driving the market's behavior. By the end of this explainer, you're going to have a crystal-clear understanding of the underlying mechanics at play, which will give you the confidence to look at your portfolio not with anxiety, but with total clarity. Let's get into it.
Section 1. A mysterious market drop. The paradox of falling stocks and steady rates. So, here's the million-dollar question. We've all seen the major stock indices take a massive, noticeable drop recently. Now, traditionally, we associate those kinds of market drops with genuinely bad economic events, or immediate interest rate hikes that make borrowing way more expensive for businesses. Yet, the Federal Reserve didn't actually officially raise interest rates right now. Literally nothing fundamentally changed in the cost of capital today. So, what gives? Why the sudden sea of red on your screens?
To solve this mystery, we have to peel the onion a bit and understand a fundamental truth about how investing actually works. The stock market isn't a mirror reflecting today, it's a lens focusing on tomorrow. It's not reacting to today's reality at all, but rather it is aggressively pricing in tomorrow's expectations. If you only look at what's happening at this very exact second, you're always going to be a step behind the broader market movements.
Moving on to Section 2. The power of expectations. The invisible mechanics of the market.
Think of the stock market not as a thermometer just checking today's temperature, but as a highly sensitive weather forecast for tomorrow. The market acts as this massive forward-looking machine. It gobbles up every piece of available data to predict and price in future economic shifts before they even happen. The recent volatility we've seen isn't because it's raining right now. It's entirely driven by a sudden shift in what investors expect the financial weather to be a few months down the line.
And this brilliantly illustrates the crazy domino effect that just took place. Let's walk right through it. Step 1. We got data showing a surprisingly robust and strong economy. People are spending, businesses are booming. Step 2. Because the economy is running so hot, the forward-looking machine immediately generates a fear of future rate hikes. Investors just assume the Federal Reserve will eventually have to step in and cool things down. And Step 3. That fear of the future causes a massive market drop in the present.
I know. It sounds completely counterintuitive, right? In the real world, a strong economy is amazing news. But in the world of short-term market noise, good economic news can actually trigger panic. If investors believe that a booming economy will ultimately force the Fed's hand to raise rates to fight inflation down the road, they smash the sell button today. They are literally anticipating future financial rain just because today is a little too sunny out.
Which brings us to Section 3. The new FRB factor. Uncertainty at the top.
Okay, so mathematical expectations are only half the story here. We also have to factor in human uncertainty. According to our structural analysis, the second huge driver for the recent decline is a pervasive sense of uncertainty surrounding the new Federal Reserve Board leadership. Look, markets crave stability. They desperately want to know exactly what the referee is going to do next. When the leadership's communication approach creates instability, it ripples out into the markets instantly.
There is just a stark contrast between the past and the present. The old FRB style was heavily categorized by highly predictable communication. Investors generally felt they were being telegraphed the Fed's moves months in advance. But the new FRB style, it's less predictable. The messaging is different, maybe a bit more reactive or ambiguous, and honestly, that exact ambiguity is what's currently spooking everyone.
When that forward-looking machine we talked about earlier can't easily decipher the Fed's next move, it doesn't just sit still. It completely defaults to extreme caution and volatility. Unpredictable communication acts as a massive amplifier for short-term market jitters. When humans are forced to guess, actually, scratch that. When the market is forced to guess, human nature kicks in. We prepare for the absolute worst-case scenario, which is exactly why we see those plunging indices.
Section 4. Short-term versus long-term. Crossing into reality.
Now that we've solved the mystery behind the panic, it is absolutely crucial to distinguish between two very different forces at play. On the short-term side, we have fluctuations driven by exactly what we just discussed: interest rate shift expectations, daily moods, and unpredictable press conferences. But on the long-term side, we have true value. And this is driven by something entirely different: actual corporate earnings. Over a long enough timeline, the daily moods completely wash out, and the true value of the businesses you own takes over.
Once it really clicks for you that actual business performance and corporate earnings dictate long-term success, your entire perspective shifts. The daily panic over rate expectations and Fed communication just begins to fade into the background. Realizing that companies are still out there producing, innovating, and generating real revenue provides a true North Star for your investments. It guides you right through the temporary fogs of volatility.
Finally, let's get into winning the long game, your strategic playbook.
So how do we actually react to this calming analysis? Here is your strategic guide for winning the long game, drawn straight from our findings. Number 1, ignore the daily market noise. Seriously, tune it out. The day-to-day fluctuations based on expectations are just pure distractions. Number 2, maintain your current positions. Please, don't let a temporary dip trick you into locking in a permanent loss. And number 3, hold on to diversified indices like the S&P 500. By staying broadly diversified, you are betting on the long-term upward trajectory of the wider economy, which completely insulates you from the failure of any single company.
The ultimate message derived from our source material is elegantly simple. Remain steadfast. Volatility is a feature of the stock market, folks, not a bug. When you know that the structural foundations of your long-term investments are totally secure and that short-term drops are merely a byproduct of expectations and communication quirks, you gain the superpower to just simply hold your ground. As we wrap up this explainer, I want to leave you with a fundamental principle and a quick question. We all know that time in the market consistently beats trying to time the market. The long-term trajectory rewards patience every single time. So ask yourself, are you really going to let short-term expectation-driven noise shake you out of your long-term financial reality? Stick to your strategy, focus on the structural truths, and let the market do its heavy lifting over the long haul. Thanks for hanging out with me today, and keep learning.